So the age, I'll talk about age-based investing over here. So when we talk about investing, there are a lot of options which we have in front of us, like equity, debt, then cryptocurrency, real estate, a lot of options we have. So there's a very common rule in the industry which says when you are in your 20s, the major percent of your funds should be invested in the equity because your risk capacity is high, and rest around like 25% you can keep it in debt and cash investments, because when you are a student you have a lot of support from your family. You don't have any responsibilities, a lot of responsibilities to take care of, so you can always take high risk, and equity is the high risk category of the investment horizon, investment opportunity. Then as person moves towards 30s and 40s and 50s, the percentage of the equity in the portfolio should decrease. From 75%, you should bring it down to 60%, 40%, 20 to 35%. And eventually, by the age of your retirement, you should not have a lot of your investment into equity, because equity markets are volatile. When the market, suppose there is an emergency, or there's some situation where you need to use that fund, but the markets are at all-time low in that time, so you can't pull out that money. So as you age, as your responsibilities increase, as your as your needs of money increase, but your revenue, your income is not there, you should try to keep more of debt and cash in your portfolio. But yeah, obviously you guys are all in the age of 20, so you can always keep 75% of the equity in your portfolio. Any questions over here? Any doubts?
What does this debt actually mean? Like difference between equity and debt?
Yeah, so debts are, there are debt funds. So basically when corporates, they need money for their projects or for their expansion, what they do, equity is very last stage, that is the IPO stage. But before IPO, how do these companies raise money? One is through private investors doing private funding to these companies. The other is the debt funding, which they secure from the banks. And then there is also bonds which are listed, where the company bonds are listed, and you can buy those bonds, or you can take corporate FDs, where company will give you a fixed return against the money they take from you. For example, Bajaj Finance, HDFC, these companies, they all have a corporate FD program ongoing. The corporate debt funds also, like equity mutual funds, there are debt funds also where you can invest. But in the corporate FDs, they'll give you 9%, 10%, 11% interest, and the amount which you'll invest is secured compared to equity. So what happens in the case, suppose a company has 100 rupees of liability from a debt investor, then a company has 120 rupees of liability from equity investor. So in case the company is not performing well and the promoters have to dilute the company, then they sell the assets, and debt holders have the first right on that money, which is, suppose so their total liability is 220, but when they sell their asset, they're only able to generate 80 rupees. That complete 80 rupees will go to the debt holders of the company. So debt is more secure compared to equity, and the terms are very transparent. Equity terms, there are no terms as such when you invest in an equity. That is a call which you take. But when you give debt to a company, there are defined terms, and there are defined period of investment, and there is defined interest rate. So the debt component is more secure.
In the last slide, what's that 13% about? Like I didn't
13% of your savings. So of your 100% income, 30 to 50% is expense. Then there are some installments going. Then there's a savings chunk. In that savings, you should keep aside an emergency fund. Suppose 5 lakh of emergency fund you have kept aside. Then the rest portion is your savings. So 75% of that saving should be, you should try to keep it in equity, and rest 13% would be an ideal allocation towards debt, and rest 12% towards cash.
Yeah, okay, got it. Thanks.
And while investing, it is not just that we blindly go ahead and invest 75% of our portfolio in the equity. We also need to have a very goal-based approach towards investing. Suppose I am targeting to buy a car in couple of years. So I need to start putting aside a money. So as you see, we have an example that, in the future, you want to invest in a house which is going to cost you 20 lakhs. Current value of that house is 20 lakhs. But do you think after 10 years that house will cost you 20? No, the cost of house is going to increase by the inflation rate. So that house after 10 years is going to cost you around 36 lakhs. So you should start in planning your investing amount accordingly. That, I need this much of amount today, which is gonna translate into this X plus Y amount. And for this X plus Y amount, at the present interest rate prevalent and interest rate and return rate prevalent in the market, this is the amount I need to start keeping aside. These can be short-term goals like car or wedding or a vacation. Suppose you're planning a complete Europe tour. So you need to start building your portfolio investments accordingly. And your long-term goals can be the family planning, the child's education, wedding, house, anything. So not just blindly putting your money in the equity, just keep your goals also in mind. Start thinking from that perspective, then you'll know, if you can use 30% of your income towards expense, or 40 or 50 or even 60. So this goal will help you understand how much you can keep aside for your future.